Now, before we go into the next example, remember at the beginning of this chapter when we went through the checklist, we talked about probabilities and how they play a part in every single trade that you take because nothing works 100% of the time exactly the same way it's worked in the past. Things change and each trade is very unique in itself. So all we can do with the parameters on our checklist is try to shift those probabilities in our favor. And it's about being consistent behind how you read those parameters, how you go through that checklist, that consistency is going to determine your success. So here in this example, we first always are looking at the TDI. We see that the liquid 50 started the day in the sell zone, just barely. It was under that stationary 50 value here. It then actually crosses up overnight right at the end of the Asian session and moves into the buy zone, which would then make us think, okay, we are maybe building some momentum to the upside, but at the same time, we've spent most of the day already in the sell zone. So just judging that on probabilities, we know that that isn't a great setup. Why? Because when you ask yourself the question, what could be better? Well, this could have been in the buy zone, which would have been a stronger indication that there was going to be a move higher today. So starting that off right there, you know that probabilities could be better. Looking at the EMAs, we can see that they're actually counter trend. Price action is using the 50 and the 200 as short-term support here overnight to move higher towards that 800 EMA. As we move higher towards the 800 EMA, I've told you this already, but we would normally use that as the ceiling for that counter trend move, knowing that once we got back to the 800 EMA, it can get choppy. But this example was important for me to show you because even here with a swapping liquid 50 and counter trend EMAs and being at the 800 EMA where you would think it could be a ceiling, this still moves higher over 2 to 1 off this 2-candle formation here. So it's a 2-candle formation that breaks for a new high of day. It's off the 21 EMA, but it is so close to the 800 EMA, you might be worried that that could be support. And here, you could see it chops around before actually breaking through and moving higher. Now, more often than not, this will not happen. But it's important for me to show you that even here, with two huge factors on your checklist not working in your favor, this still ends up putting money in your pocket if you traded this formation. But more often than not, trading with this many parameters not fitting your exact trading plan, not fitting the exact system, more often than not, this trade doesn't work out in your favor. But it's important to understand that even though you analyze it the same way every time, probabilities still can shift. So here, when probabilities aren't in your favor, it doesn't mean it can't work out, it just means it probably won't. So you want to try to weigh that into the trades that you take. You want it to be more in line with the idea that the probabilities are going to put things in your favor to see it move. So what could have been better here? The 800 EMA could have been on the bottom. The TDI could have been in the buy zone all day. Two things right there that would have made this a full trending, clearly uptrending pair where taking it long would have been the right move. Here's another example. This one overbought overnight, but then keeping that liquid 50 in the buy zone, holding the uptrend on the EMAs. You can see holding the 50 EMA all night, basically making higher lows as the day went on. So again, more confirmations here that you're in an uptrend. This is NZDJPY on the 15-minute chart. And as you can see, it's a 6-pip stop right underneath that entry candle open price plus your spread. And it runs about 13, 14 pips, never breaking the 8 EMA. So 2 to 1 smashed, you're getting almost 15 pips as we know we normally are looking for. But if you're only risking 6, you're looking for 12 there at 2R. So if you can go in, risk 6 to get 12, that's a good potential risk reward setup. It's a good trade that you want to be involved in, especially when the EMAs and the TDI are both telling you the same thing here, both telling you to go long. It's a good looking TDI. It's not really overbought during the trading session previous. It was overnight, but during the London session, it really wasn't. So this breakout here at 11:45, kind of almost in the afternoon, to me would make sense. You kind of see the consolidation here. You see it making higher lows. Like I said, holding that market structure with the TDI in the buy zone, more often than not, it's going to move higher. If EMAs are in an uptrend, you're making higher lows, and the TDI is in the buy zone, you're probably going to see movement higher by the end of the day. Here's another example on NZDJPY. This is during the Asian session. This one is a powerful shift off the 50 through the 21. It actually breaks past yesterday's low really, really nicely because you can see the day before was pretty choppy, pretty sideways. Multiple hits to that low of day, 71.15. This candle ends up pushing down to 71.10, breaking that level by 5 pips and then falling 40 pips, only risking 12 or 13. So your stop goes right at the entry candle open price plus your spread, and look at how it never breaks the 8 EMA all the way down here to 70.80. So a really, really solid rip there. Very easy to stay in this trade. each candle 15 minute by 15 minute. And just look at the TDI. It's in the sell zone and it breaks to the downside. The ascending trend line on the price action confirmed with the ascending trend line on the RSI there. And again, there's your RSI cross. TDI in the sell zone, RSI coming through the liquid 50, coming through the trend line with space to move lower, not oversold. So everything lined up here. And again, this goes into waiting for the perfect setup. There could have been maybe, let's say the liquid 50 was in the buy zone coming into the sell zone. You would check that off on your list and say, look, this is something that's decreasing the probability of my trade. Maybe I don't want to go full size into this because it's a swapping liquid 50. Or maybe the EMAs aren't in full trend, like in the previous example. And you say, look, let me just size down and take the trade anyway because it's a good setup except for this one factor. So if I take a smaller position, just slightly smaller, then I know at least I'm not taking the full risk of as if it was a perfect setup, because it's not. And I'm at least analyzing it unbiased and making that decision from a logical standpoint, not an emotional standpoint. So here, another example, CAD CHF. This is a 4 candle formation off the 21, nice little pin there to the 50. This is after a shift candle overnight. So you see the consolidation overnight. You see the EMA starting to pull under the 800 EMA, the 50 coming down, the 200 coming down, and we shift overnight. And it's a good shift confirmed on the TDI because the RSI comes through the liquid and it's under the trend line. It's in the sell zone, right? So that shift candle is good. That sets the downtrend for us. We see the EMAs coming down. We see the liquid 50's been in the sell zone. So where's our bias? Short. We're looking to take it short. The only entry that we see here is off the 21 EMA here at 1:15 in the morning. This ends up breaking, like I said, about 16 pips to the downside. Never breaks the 8, never breaks the 21, just some pins. But again, we judge it based on candle closes. So even if it pins up, don't pull the trade. Leave your stop alone. You're only risking 5 pips, and this goes 3-1 on this setup for you. So all you have to do, take the entry when it presents on the candle close right there at 1:15, set the stop where it's supposed to be, and let the trade go. Go for 2R, go for your 15 pips. Either way, both of those were smashed here on this example. Here's another example, CAD CHF. We see this liquid 50 rising as the day goes on from the start of day, the changeover of day. Here we see it come into the buy zone and then really pick up, some momentum here and move higher up to that 60 value. So the market sentiment was very clearly rising. Price action actually breaks the 800 EMA, kind of chops around at it before here at 2:30 in the morning, pushing off the 800, pushing off the 21 and breaking for a new high of day. It also breaks the descending trend line. You see no divergence there, right? So you know if you can get a good formation off a breakout here and you can break the structure that's confirmed on TDI and price action, then that breakout's going to be really solid. Here, you're risking 6 because your entry candle open price was about 6 or so pips below. So your stop loss is 6 pips beneath your entry and it goes 16 pips. Now, again, you're looking for 15, you're looking for 2R. Both of those smashed here, and only once does it break the 8 EMA. It moves higher, pulls down, breaks the 8, which again could be an exit to maybe take some off, but wait to see if it breaks the 21 before you really say the trend is done. It doesn't. It doesn't even touch it, and then it goes to 16 pips. So again, reaching your 15. Here, CAD CHF, I have another example for you. You can see the consolidation overnight through the Asian session because neither of these markets were open. So of course, trading is going to be slow. That's why they're small candles. To get the day started with the TDI perfectly in the sell zone, EMAs are clearly in a downtrend, you see the RSI is already under the trend line. And then at 3:15, you get your strong shift body off the 50 through the 21, right? So it's a beautiful shift, breaks for a new low a day, breaks past yesterday's low a day, and from there it falls 21 pips. So you're risking 15 and it falls 21. Doesn't go full 2-1, but it does give you that 15-20 pip take profit range we talked about as our first take profit level. Notice how after it hits that 21, it slowly chops its way back up towards the 8. So it does give you a few candles here, a few 15-minute candles to get out of the trade. Notice that it hit oversold. So the fact that it went more than 15 pips and hit oversold, both of those together should say, look, you should have had some off. At least half the trade off at 15 pips. That's the safest thing to do. And then lock the stop loss in profit so you can't lose and manage the trade as it comes back to the 8. Knowing that you can't lose any money, you could wait to see if it breaks the 8. It just happens to do it here with a strong bar. Either way, as long as you take some off at 15 pips and then lock the stop loss in profit, so even when it reverses, because you know it moves in waves, even when it reverses, it doesn't make you lose the trade, you'll come back for the next one. So take some off at 15 and then manage. And watch how it slowly pulled up higher after it hit oversold. Eventually, you're going to look at it and say, you know what? It's oversold. I'm up 15 pips. Let me just take it. I didn't get the 21, so what? I'll take the 15, I'll take the 10, and I'll move on to the next one. So again, when it breaks, you get your 15, you take some off, you lock the stop loss in profit so you can't lose the trade, and then you manage it as it breaks EMAs from there. Here, this is an example where you just take a loss. This is a TDI in the buy zone, EMA's in an uptrend. It's a huge shift bar off the 50 through the 21, and as you can see, it never moves higher for you. The stop was only 5 or 6 pips away though, so you take your risk, right? You know that it's CAD CHF. You know, because I'm telling you, CHF pairs are slower, CAD pairs are slower. They don't have as much volume or volatility, so you're not going to get 80 pip runners on these pairs. It's low risk. You shouldn't be in these trades super heavy. You take the 5 pip loss, you move on. Go look at the GBP pairs. Go look at a pair that's moving. You're going to find more action there. Here, the one thing you can note to say maybe I should have avoided the trade is the dropping market sentiment line. The RSI is above the trend line and above the market sentiment line at the time of the entry, but as you can see, very quickly it pulls back down underneath it. So the one factor about it that I would say maybe played into it was the dropping market sentiment line. This example, Euro AUD, recently here, July 2nd, was a shift candle right before midnight, right, 11:15 or so, off the 50, off the 21 EMA with a beautiful RSI cross, under the trend line, under the liquid 50, not oversold, TDIs in the sell zone, and it breaks for a new low of day. It doesn't break past yesterday's low, but it breaks for a new low of day past the Asian range consolidation. It breaks and moves all day, 65 pips to the downside, never even touching the 21. And these are the great shift candles that you want to be involved in. I've shown you a ton of examples already, but again, they're all still relatively coming back to the same foundational knowledge, which is where's the TDI? What's it telling me we're doing? What are the EMAs telling me we're doing? Do they both agree? Are we trading in the same direction? Okay, good. I'm going to read the EMAs and wait for a break. Here, you get a break, which is your entry candle off the 50 through the 21. Again, 11:15 at night. RSI comes through. You have your TDI confirmation, and it holds the 8 EMA all long. So all you have to do is sit in the trade. You get 4R on this trade. So your 15 pips, easily reached. Your 2-to-1, easily reached. 3-to-1, easily reached. And then again, if you continue to manage it and just slowly exit the trade, take a little bit off, 25% off, a little bit more off, a little bit more off, 10% off here, you can manage these trades and let them run for hours and hours sometimes only by reading the chart. Read the TDI and read the EMAs. Is it staying in the sell zone? Is it making lower lows and lower highs? Is that downtrend continuing? Yeah. Okay, so I'm staying in the trade. It's still moving lower. You don't want to get emotional and be like, oh, this is the bottom. It's no way it can't go lower. Yes, it can. Look, it hits oversold here and then still comes lower. So if you had exited here at oversold, you still, quote unquote, could have left money on the table. But that comes back to the rules. And again, take profit 1, 15 pips. Take profit 2 is either 2R or 3R. If you can hit these trades successfully, the way I'm teaching you to in this course, getting 2 to 3R out of them when they present, you're winning 6 to 7 out of 10 trades. You're going to be making money. Your account's going to be growing and compounding pretty quickly. Your size in each trade is going to continue to grow. So it's about winning, and it's about staying in winners until they tell you not to. You don't want to get emotional and pull trades just because you're up in profit. You're going to make money. That's what trading is. You're also going to lose trades, and you have to be unemotional there too. Like I just showed you, you pull that trade. You just take the loss. No worries. Move on. You're going to find setups like this the next day. This is 65 pips. You could have found this that night. You know what I mean? So cut the loss, move forward, and then again, let winners be winners. Here, another example, this is another JPY pair. It's AUD JPY. It's a beautiful shift candle. Look at the pins to the 50 and the 200 EMA overnight, showing us that there's a lot of resistance up there and we cannot break. How do we know that we're still moving to the downside? EMAs are in the downtrend and the TDI is perfectly in the sell zone. Look at the liquid 50 in the sell zone. You get your RSI cross right here, 2015. Boom, 74.36 is your entry price. This falls 22 pips. Over 2 to 1, again, 15 pips getting smashed, 2 to 1 getting smashed, never breaking the 8 EMA. And even once it gets down here, look at how long it's slowed down for you here, even just sitting in profit, not breaking the 21. Even when it breaks the 21, if you're still in the trade here, getting closer to 3 in the morning, get out of the trade because it's now giving you plenty of signals that it's done. Look at the RSI starting to rise. Look at price action starting to rise. Get out of the trade once it breaks. But before that, read the EMAs, read the TDI. Okay, we're holding the trend line. We're holding the liquid 50. The liquid 50 is falling. EMAs are falling. Let the trade go. You're only risking 9 here. So to go get 20, it's a great trade. In this example, we're looking at AUD JPY again. This is at 9:30 in the morning, so this is during the New York session when this pair is still being traded, right? But it isn't the most volatile time for it because the Australian dollar and Japanese markets are both winding down at about this time. So you're going to see less volume. You're going to see smaller movement. And on top of that, if you take a look, it was actually oversold overnight during the Asian session when you saw a really nice push down. So the downtrend is clear because the liquid 50s in the sell zone, the EMAs are in the sells or in a downtrend. So everything's telling you that this is short biased. You see the move down overnight, that sets it to oversold, and I think that's why here this doesn't even go a full 15 pips. At most it goes 14 and a half, but only risking 8 because this is your entry candle open price plus your spread. Only risking 8, you're still getting almost 2 to 1. You're still getting a nice little pop here, and it does sit at that take profit level of 74.50, 74.48 nicely. You can see it hits it, comes back down and retests it, where you then start to see the RSI rise. So it gives you the potential to get out of that trade in profit regardless. It is just not a big mover. It's not a fast pair when you're trading it at this time of the day. I would look to trade AUD/JPY during the Asian session. You're going to find more movement, more volatility, because that's when that pair is open. The banks in that market are open and things are being done at a higher volume. Here, a 2-candle formation off the 21, off the 50. You have a swapping liquid 50 just barely here as the EMAs cross over and you go into that full downtrend with the 50 underneath the 200 and the 800 on top. So your EMAs end up in that full downtrend as the liquid 50 swaps into the sell zone. The RSI really nicely under the trend line for majority of the morning since, basically midnight on, it was in this position underneath the trend line. You get your downshift on the candles, but it isn't a solid downshift because that body is not off the 21. So you wait. You don't just enter on a shitty shift candle like that. You wait, it pulls back, you get the 2-candle formation, you take your entry there at 2 a.m., stop 6-7 pips above your entry candle open price, and you just watch the TDI, watch price action. This falls 22 pips, only risking 6 or 7. So very, very clean. 15 is smashed, 2R is smashed, 3R is even reached here without breaking the 8 EMA. So RSI falling, you can see it actually breaks the trend line and then starts to rise. Even though it pops back down and then continues to rise, that's where you're going to see trend start to change direction, see a signal that you might want to be out of the trade. Then it breaks the 8, breaks the 21, and even if you're still holding the trade, look, you're still in profit there from the entry. So if you still were holding a small piece, once it breaks the 21, that's where you would say, look, this trade's done. Maybe I didn't close it well, maybe I did close it well. Regardless, once we break the 21, that's a signal that the trend is changing and you want to be out of the trade. Here, Euro-JPY, again, a pair that's going to move in the Japanese session, in that Asian session. This is a shift candle off the 50 after a nice pin to the 200 with about 12 or 13 pips worth of risk. This falls about 23 pips, almost 2R, but again, still reaching that 15 to 20 pip take profit level before turning around and breaking the 8 EMA. So even if you held, just like in the previous trade, you were still able to close in profit once it started to break the 8 EMA. But look at the extension off the 8. That'll tell you, hey, we're pretty far off the 8 EMA. At some point, we're going to have to pull back and retest it. So once you start to see it's really, really extending, when this candle was down here filling this wick, when it was pushing down like that, it's extending itself really, really, really low. And if you look at the 1 minute or the 5 minute, you're going to probably see it oversold. So you can't go wrong taking off profit there, especially because you're up over 15 pips. The other thing about this trade is you'll notice it's a swapping liquid 50. So here, probabilities aren't as good as they could be, but still in your favor because you're trading it when it's in the sell zone. It did start the day in the buy zone, which could have been better. It could have been in the sell zone all day, and that would have been even more confluence for our trade, more confidence behind the direction. Euro-JPY again, this is just a loser. Look how beautiful the TDI is here. Perfect in the sell zone, not oversold. The EMAs could have been better, right? The 200 could have been below the 800, but when you took this entry, as you can see, the rest of the day it ends up actually pulling underneath it, but you were just in at the wrong time here. It breaks for a new low a day. It's a big 2-candle formation that ends up pulling back and stopping you out. If you did take this candle formation and get stopped, as you can see, there is another large 2-candle formation here after the fact that you potentially could have gotten back in on and made money as it fell, never breaking the 21. It broke the 8 for about 15 minutes and then came right back down. So if you take the first entry, you get stopped, don't chase it. Just wait. This ends up presenting another formation. If you like that formation, take it. If you don't, just sit out and wait for the next best setup. You're not going to win every trade, even with a beautiful TDI like this. There's still going to be losers. I can't stress that enough. We're not just talking about the trades you should be in. We're talking about trades that you should avoid. And we're also talking about trades that you are going to take and still get stopped out on because the market still has random events that happen. The market still is going to move in unique ways every single day. Here is that second formation just a few hours later. Look at the difference, though, with the TDI positioning. Here, the trend line was just barely above the liquid 50 as the RSI came through it. Here on the second formation, again, breaking for another new low a day, bigger stop loss, about 19 pips, but the RSI was well under the trend line and liquid 50 at the time of the entry. So yes, it does pull back for 15 minutes, but if you give it an hour or two, it takes you down into profit. And if you wait about 6 hours, it takes you all the way to 31 pips, which is almost 2 to 1 on your trade. You're getting your 15, you're getting your 20, no problem. And then you can see it just sits down there. So it gives you a few hours to get out of the trade up 20, 25 pips, only risking 20. So either way, you're still making money and you're just reading the chart. Look at the liquid 50. It's clearly telling you this is going to move down today. So even if you took that first position back here and you get stopped on the pullback, as I showed you in the previous slide right here, this second formation is still a valid entry signal, and you still can adjust it just reading where the entry candle open price is and making your determination of is there risk reward lined up here based on that number. So we're risking 20. Can we go get 15? Can we go get 20? Can I get 40? No, I only got 31. It's still a good trade. You know what I mean? You're still reading and analyzing that and putting probabilities in your favor. This is an example of just a straight up loser. You have a TDI in the sell zone. EMAs are clearly in a downtrend. It's a huge 2-candle formation right at 3 a.m. that ends up coming right back and stopping you out for about a 17 pip loss. What could you do to avoid this? Well, it breaks out past yesterday's low, which is what would induce a lot of people. For me, this would be what I would call overextended. It's a huge candle, bigger than any candle that we've seen during that previous day's trading, during the Asian session and the London session before. This could have been driven by news. It could have been driven by some reaction to a tweet. Who knows what could have driven this candle, but it is irregular. It's way bigger than everything else we've seen, and that keeps me out of trades sometimes. That overextension of the candles will keep me out of trades, even in a perfect liquid 50. So for me, I probably wouldn't be in this trade. I would suggest to you to turn away from overextended candles like this, and even like the candles here in the previous example, you'll find better trades. Of course, these end up working out for you, and this one doesn't. I wanted you to see the difference of trading overextended candles, trading these large formations, and how sometimes you're just going to take losses. Now, that 2-candle formation that would have stopped you out right here on that pullback to the 50 still ended up coming lower by the end of the day. This was news here at 8:30 in the morning that ended up pushing the CAD pairs lower. This is Euro CAD, right? So what do you learn from this? Well, here, if you had taken this first position, gotten stopped out, and lost your 17 pips, but then you come back later in the day and you see it's much lower, you're going to ask yourself, well, what could I have done better? Nothing. If this is a trade into news, we're not trading it. If this is a trade you take and you get stopped, you move on to the next trade. You don't chase it. You don't sell it mid-candle. You don't go after it like that. You have to read and react. And sometimes you're going to be trading the right direction just early. You'll hear me say it a lot. Very rarely am I wrong. I'm just early. And why is that? Well, because the TDI doesn't lie. In this previous chart, look at the liquid 50. It's in the sell zone. That day, it still stays in the sell zone here. So you're still going to most likely see this thing move down. But it just happened to not work out in our favor. It happened to stop you if you traded it earlier. If you didn't trade it earlier and you just saw this move down, you wouldn't care because you knew this was a news move and you wouldn't feel any FOMO because we don't trade news events like that, high impact news. So this is just something that moves. You read the direction, right? That's great. But trading isn't just about direction. It's about timing. And here, the timing didn't work out for you. There was no solid entry. With this example, this is NZD USD. Again, not a super volatile pair, not a pair that moves a lot, but this 3-candle formation closes at 9:15 in the morning during the New York session. So the US dollar is open. This pair is trading. It breaks for a new high of day. EMAs are coming into an uptrend, and the TDI is telling us to be long biased all day. See, never overbought, sitting in the buy zone, right above that stationary 50. This runs up, never breaking the 8, 20 pips, 21 pips, only risking 10. Perfect. 2 to 1 smashed, 15 pips smashed, no problem at all. If you ended up holding too long, it gives you multiple hours of consolidation here at the 8 EMA to get out of the trade in profit as well. So still, trust the rules. Go for 15, go for 20, and if you want to keep some on and try to manage it with your stop locked in profit, fine. But make sure you're taking some off the table. You got to take profits at 15. You got to take profits at 2R and then at 3R. You got to take money off the table. That is the key to longevity in this career. If you are not booking profits, you're not going to be able to grow your account. You're not going to be able to size up, and you're going to burn out. So make sure you're booking profits. Here, another example on NZD USD. This is important to understand. This 2-candle formation would not be valid. Yes, the TDI is in the buy zone. Yes, the EMAs are in an uptrend. But what's wrong with this? That right leg coming off the 21 with that pin to the 50 is not higher than the left consolidation zone, right? You see how the right leg is not? This next candle does take us above, but that's not part of the formation. That's off the 8 EMA. That's off no actually EMAs at all. So that's not a part of this formation. But this 2-candle formation would do some traders, but because we know if we're going long, the right leg must be higher, we wouldn't take this trade, even with the TDI looking how it is, rising, right, in the buy zone. And what ends up happening, look at this pin right here. This pin would have came down, hit your stop loss, which would have been at your entry candle open price, stopped you out, and then moved higher in the next 15 minutes. So cool, we read that it was going to go long. That's really easy. Look at the EMAs, look at the liquid 50. But the candle formation wasn't there, and if you would have taken it, you could have gotten stopped. And I would tell you, you can easily avoid that loss by not taking this trade. Or you'll say, Austin, well, what if I take the trade and it never pins me out and it goes higher? That can happen, absolutely. But more times than not, when you're finding a right leg that's lower than the consolidation zone in this situation, when you're trying to go long, you're not going to have that trade work out in your favor. It's going to chop you around still. There's a reason why it didn't present the right way, and that's because it still wasn't ready to make a clean move. So you want to have really solid candle formations to match up what you're seeing on the RSI so you don't get pinned out like you would have in this situation. Here's one of those examples where the right leg does not close higher than the left consolidation and it still ends up moving higher for you. So you're going to have to leave this on the table. I would not size down into setups like this because you don't know which ones are going to work for you like this. And this doesn't even move much. We're talking 6 pips here from where you would have entered to where this goes. So it's not even like it's a lot of money. Why would you risk that when you could end up potentially like this guy getting stopped out? It's just not worth it. Wait for really solid 2 candle, 3 candle, or shift candle formations. Like this one. This is a 4 candle formation off the 21. You can see the stop is about 5 pips above your entry price. Low risk here because it's NZD CAD, right? Not a super volatile pair. But what happens? You give it time. It goes to 15 pips. That's 3R. You're risking 5 to make 15. All you have to do is enter overnight, let it sit, and before 3 a.m., your 2-to-1 take profit was smashed. You were out at 10 pips, a little bit of your position. If you held, you could have gotten 15 out of this at 3-to-1 as well. Here we're looking at NZD CAD again. This is an example of a trade that you want to avoid. Let me talk to you about why. First, we always look at the TDI, right? You can see it's a swapping liquid 50. It started the day in the sell zone and moved its way overnight into the buy zone. So short term, it's telling us that we are in an uptrend. Market sentiment wants to move higher. However, we know that could it be better? Yes, that liquid 50 could have been in the buy zone all day. Then we look at the EMAs. We see that the EMAs are actually counter trend. You have the 50 below the 200 and the 800 was actually up here. So this move that happens later in the day is counter trend. But the initial shift candle that could have induced you at 445 broke the 50 and broke the 200 with one strong body through the 21, through the 8. Right there, you can see it. As the RSI comes through the trend line, comes through the liquid 50. So it looks good on the TDI and the candle itself. But because it's a swapping liquid 50 and because it's counter trend to the EMAs, it ends up actually coming down and stopping you out before moving higher. And that happens a lot with these swapping liquid 50 trades, is that it'll end up actually stopping you out or chopping you around before moving in the direction that the TDI tells you it's going to move by the end of the day. So if you're going to trade swapping liquid 50s, in my opinion, I would definitely trade them smaller and I would definitely wait on them and make sure that you're getting in at the best possible entry. And if you get stopped, don't change your direction. Look at the liquid 50 and wait for potential re-entry signals. Here, we're looking at NZD CAD again. This is another swapping liquid 50 trade. Here, this is a 3-candle reversal that breaks previous consolidation after a shift candle down with the liquid 50 in the sell zone. Now, the liquid 50 has been in the sell zone majority of the day. Since before midnight, it was all the way through till 8:30, it was in the sell zone. So that short bias is there. Then it's confirmed with the EMAs. The 200 and 800 are on top of the 50 and price action is below that. So the EMAs and TDI, for the most part, are confirming we're trading short today. And that's why this breakout works. 18 pips, only risking 10. And that puts money in your pocket before news here shoots it back higher. So again, this is a winning trade. You're in the trade, you're going for 15 pips, you know news is coming, take the 15 before news comes, move on to the next setup. Do not hold into the trade if there's high impact news coming. And again, if you're trading a swapping liquid 50 and you get 15 pips, you better be really happy with that, because swapping liquid 50 means what? Decreased probability. So to make money on a trade where probabilities are actually decreased, it could have been better. You want to be very grateful for that. Take the winner and move on. This is GBP USD. This is a 2-candle formation after a pretty decent shift candle, but just wasn't clean. The 2-candle formation here breaks for a new low of day. TDI is in the sell zone. RSI is well under the trend line, well under the liquid 50. Everything's in position here. So once you get this 2-candle formation for a new low of day, and at 3:30 in the morning, that right leg closes, EMAs are in a downtrend, TDI saying sell it. You take the position, stop at the entry candle open price about 10 pips above it, let it do its thing. Here, this goes 25 pips. It actually ends up moving lower if you hold it into later in the day. But look, never touches the 21. It breaks the 8 with one candle, comes right back down. Breaks the 8 with one candle, comes right back down. So the trend was very clear because of the EMAs, because of the TDI, and then it's just about setting the take profit, setting the stop loss correctly, and letting the trade develop. Here, GBP USD again, a nicer shift candle here. This is 3 o'clock in the morning on a separate day, but that shift candle comes right through the 50, right through the 21 with the TDI beautifully in the sell zone, EMA saying to sell it, and the RSI well under the trend line, well under the liquid 50 at the time of the candle confirmation. This candle breaks past the Asian session low, past yesterday's low set here. You can see it was set, tested at the changeover of day, tested during the Asian session, couldn't break above the 50, couldn't pull the liquid 50 into the buy zone, finally shifts down, and that shift candle takes you 23 pips, only risking 12. So again, almost 2R there, but definitely getting your 15, definitely able to close this trade here when it breaks the 8 in profit and lock that trade as it moves lower so you can't lose any money at all. So clean breakouts because of the TDI, because of the EMAs. It starts there. EMAs and TDI are the foundation of the signal. Here, a few days earlier, on the same pair GBP USD, this shift candle ends up holding the 8 EMA all day long, only it once, coming right back down, breaks it once, comes right back down, 63 pips here. You see the EMAs are in a downtrend. We've been very short biased all through May, all through June, on all the GBP pairs because of Brexit. So you're taking that fundamental macro event that Brexit is creating, that volatility that Brexit is creating, and you're making money off it here as the GBP pairs fell all month long. You saw that when we went over the hour charts. You saw that when we looked at the daily charts of these pairs in the earlier chapters. These pairs were very short biased. So with the liquid 50 in the sell zone most of the day, EMAs in a downtrend, strong shift candle at 2 a.m. right at the start of the London session, 13 pip risk, I'll take that. And look at how well candle after candle after candle just drops you into profit. So your 15 pip take profit would have been reached, 2R would have been reached, 3R would have been reached, even 4R here, almost 5R by the end of the move. Really, really solid breakout here. And again, it's combining the fundamental event of Brexit with the sound technical analysis, the good-looking liquid 50 for the most part. It's swapping, just barely swapping, but it's in the sell zone majority of the day. EMAs say sell it, so you're very clearly short biased waiting for the breakout. Here, another GBP USD breakout. You see the ascending trend line right at the changeover into the London session again, right going into 1 o'clock in the morning. This breakout takes a couple minutes to consolidate sideways before moving downward, but if you give it time, once the London kicked in, when the volume came in for the GBP pairs, this thing heads to the downside. Why? Look at the EMAs again. Look at the liquid 50. Both are telling you to stay short bias. So you're looking for shift candles. You're looking for 2 and 3 candle formations to take you to the downside. Here, RSI is in proper position under the trend line, under the liquid 50 in the sell zone, and this takes you lower. Look, if you don't take this shift, what do you see right here? 3 candle formation off the 21 for a new low of day. Boom, there's your entry. So if you miss this one and you're like, man, this looks really good, I think it's going to go to oversold. Wait and see if it presents a clean entry signal, and that's what you get right here. So that 3 candle formation could have been another potential signal, even to add to the original entry as well. Once you're getting confirmation that it's moving in that direction, and it just falls. It never breaks the 8 EMA until it already reaches that 36, 37 pips. And look how oversold it was. So you definitely would have been taking profits here. It's extending off the 8, it's oversold. You want to book those gains. Here's that markup a little closer on the 3 candle formation. You see this one breaks out, never negative at all. You enter at 215, 230, you're in 245, 3, 315, 330 in the morning, straight profit. 30 pips, risking 10, 3 to 1. Again, just read a good TDI, read a good EMA setup, and you're going to find good breakouts like this. If it's a swapping TDI, if the EMAs are not in full trend, if there's not confluence there between the indicators, if there's no space left in ADR, you're not going to get trades like this. But when you have a volatile pair, you have a TDI in one zone all day, you have EMAs confirming that direction, you're going to get breakouts like this more often than not. And that's why, yes, some of these will be losers and you can't control it. But that's why you want to be in every time it presents. That's where it goes back to the consistency and the discipline that I talked about, that you have to exercise behind the system. You can't slack. You can't just do the checklist one day and not do the checklist the next day. You're screwing up with your P&L at that point. So be consistent in your analysis. Trust the liquid 50, trust the EMAs, and if no pairs, out of all your lists, all 30 pairs that you look at, if none of them have good TDI and good EMAs, which is going to happen, come back the next day. Don't force trading a swapping liquid 50. Don't force counter trend EMAs. It's just not worth it. Staying on the GBP pairs now, this is another 2-candle breakout formation, new low a day, off the 21 EMA. You can see perfect liquid 50, perfect EMAs. Shift candle was a few hours before, and this happens once we start trading. This is 5:15 in the morning, so I'm up, I'm on the charts. We see the breakout for the new low a day, boom, 5:15, you take your entry. This candle that breaks for the new low a day, that right leg, that's the 5 to 5:15 candle. So at 5:15, once it closes, you can check the 5-minute and the 1-minute to see if you have any other RSI crosses to confirm it, but that's a great breakout. Anytime you see 2 or 3 candle breakout formations like this on GBP pairs, they're really going to be solid. For some reason, the backtesting shows us that these 2 and 3 candle formations on GBP base pairs really work more often than not compared to other pairs even. So again, perfect liquid 50, perfect EMAs, RSI's crossing, it's breaking for a new low a day. RSI value is under the trend line and under the liquid 50, and this is the kind of stuff that you're going to get. This is going to be easy money in your pocket. 54 pips by the end of the day, your 15 pip take profit, that would be about 1-to-1 since you're risking 14. That gets smashed. 2-to-1 at 30 pips, smashed. 3-to-1 is almost destroyed within just a few hours. So I think these are the breakouts you want to get. So when you look at this markup, what do you take away from it? Perfect liquid 50s are the way to go. Perfect EMAs are the way to go. Space on ADR and a volatile pair is the way to go. That's where you're going to find breakouts like this. Another GBP breakout here, going back even further into May. This is May 16th, 6 a.m. After just barely jabbing oversold once, it throws a nice little 2-candle breakout formation there. Only 10 pips on your stop. What does it do? Breaks and just destroys to the downside. Keeps moving. Just unbelievable price action here. 40 pips, never breaks the 8 EMA until it's finally hit its bottom when it touches oversold again. When it touches oversold for the second time, if you ever trade an oversold pair like this, let's say you're like, look, I know the EMAs say sell, the liquid 50s in the sell zone, we're breaking out off the 21, but it's oversold, so I'm going to size down a little bit. That's fine. But understand that once it comes to oversold the second time that day, that's at that point, if you hold being greedy. You want to take your profits there. You're over 3R. You got to enjoy that win. You made money even though it's already oversold. The oversold sometimes shifts probabilities against you. So like I said earlier, to make 15, make 20, make 30, risking 10 after you're already trading a trade that you know probabilities aren't 100% in your favor, you got to be grateful for it. Take the money and then move on to the next trade. Because look, I'll show you another one. Here, earlier that day, before it hit oversold, you see the shift candle down that set the downtrend for the day. This is 2:15 New York time, right? EMAs say sell, liquid 50 says sell, so we're short biased. You know you want to see a break to the downside. The shift candle comes off the 21, off the 50, perfect through the RSI, and it's well under the red trend line there. So you know it's a good shift, and that shift moves 52 pips, only risking 10 or 11 by the end of the day. This shift candle is what set us up to trade this 2-candle formation later in the morning. So when you see the shift, you're normally going to see a pullback to the 21, and if it holds the 21 and can move down and continue the trend, you're going to be able to rely on that shift candle to say, yes, this is the direction for the day. TDI confirms it. EMAs confirm it. We need to just be trading this short, and that's the way we're going to trade it all day. Here, this is Euro AUD. I want you to notice again, we talked about this already, but the dropping liquid 50 is the first thing you need to notice. When it's in the buy zone and dropping to the stationary 50 or dropping into the sell zone, you're decreasing the probability that it's going to be a good long trade. So when you see the shift candle long here at 445, yes, liquid 50 is in the buy zone. Yes, trend line's in the buy zone, but it ends up chopping you around because of the dropping liquid 50. You could make money on this. If you held in through all of these pins, you're risking about 15, 16 pips. You could make 30. You could get 2-to-1 on this just about. But for me, when I see a dropping liquid 50 like this, I avoid it. Just come back and find a better trade. Find one of these perfect liquid 50s in one zone, flat liquid 50s in one zone like you see here. You don't need dropping liquid 50s trying to buy it. Just as if it was a rising liquid 50 in the sell zone, you don't need to sell that. Just find a better setup. Always ask yourself, what could be better? This is a better example here. You see the ascending trend line is broken as the RSI comes through the liquid 50, L50s in the sell zone all day under the trend line, and we see move to the downside, 27 pips, only risking about 12. So you're getting your 2-to-1, you're getting your 15 again. And again, look at the EMAs. It breaks, tests the 8, and pushes lower. Once it comes back and breaks the 8 again, that's where you know it might start to slow down as far as trend, and it does. That's where you'd want to be out of the trade so you don't get stopped out. But once it moves down 10, 15, 20 pips into profit, you better be moving your stop loss to break even just in case it turns around and spikes up. You want to lock the gains. And here, to see it go over 25 pips, you got to take profits off at that point. Another EA example, Euro AUD. This one, the EMAs could have been better. They were not in a full downtrend all day, and it was oversold. And it's a swapping liquid 50, but it still works out for you because, again, it's always about probabilities. So you want to measure it. You want to say, look, how long has the liquid 50 been in the sell zone? Here, it's been in the sell zone majority of the day. EMAs are now in a downtrend at the time of entry. You see the 200 is under the 800 and the 50 is under both of them. So it's in the full downtrend now, but it wasn't earlier in the day. And on top of that, like I said, it is oversold. So measuring all of that, maybe you just size down. But this is a beautiful shift bar breaking this consolidation at the 50. With that breakout, strong breakout bar and shifting down, confirmed on the TDI. Because it's confirmed, you can trust it. That's a good breakout. 12 pips, stop right at the consolidation zone, right at the entry candle open price. Never breaks the 8 EMA. 35 pips to the downside till it hits oversold again. And what I tell you, once it hits oversold for the second time, if you're trading it, get out, take the trade. So you're making almost 3R on this. You're getting 15, you're getting 20, you're getting 25 again, only risking 12. Now we're back into June 21st here. This is NZD-CAD, a nice shift candle off the 50, off the 21, perfect liquid 50 in the sell zone. It's close to the stationary 50, but again, read it for what it's telling you. It's in the sell zone. You see the RSI comes through the trend line, comes through the liquid 50, and that shift candle sets us through that ascending trend line that we see here. You see your first reaction point here, set here. We break that to the downside. It's confirmed on the RSI, and with that breakout again, it does not break the 8 EMA. It goes over to R. You're seeing the pattern here, I hope, right? You're risking 13, you get 37. Look, it breaks the 21, and you're well into profit. So you're, no matter what here, going to be able to close this trade for some type of profit. But you want to take some off at 15, you want to take some off at 2R, and then you want to take some off at 3R if it goes that far. Now I want to wrap up our 15-minute examples with my most recent trade. This was this week here. We see the shift candle down. You see RSI was well under the trend line. Cross liquid 50. We had a beautiful liquid 50 in the sell zone. EMAs were telling us to sell it, and this drops really, really nicely, almost 5R. Very clearly we got 4 because we were only risking 7. So risking 7, it falls 34 pips. I was out of this trade at about 25. It held the 8 EMA really nicely, and it was oversold. So once it got to oversold, I was off the 8. I was like, look, this is a beautiful trade. I'm up 3R. I'm taking it on a Monday. And this was a great breakout. You see, we broke the Asian range. Liquid 50 was in the sell zone. Tried to get above the 50 EMA here. Tried to pull things up, and it just couldn't. So once it came back down and shifted down, and the liquid 50s in the sell zone and the EMAs are in the sell, are telling you to sell it, you know you're just looking for the short breakout, and that's what we find here. So now that we went through the 1-hour markups, we went through the 15-minute markups, I want to explain to you how to use the 5-minute and 1-minute with the 15-minute chart to find the most probable trade setups. The 5-minute and 1-minute are going to be your precise indicators for entry, and they're also going to help you to know if you should be staying in the trade or getting out because trend is changing. When you use both timeframes, it should look like this. You should have the 15-minute set up on one side, I always have it on the left, and the 1-minute or 5-minute can cycle on the right side. So you can see where you are, which candle are you trading within on the 15-minute. Are you trading in the right direction of overall trend? You can see the TDI down here. You're using the 1-minute or 5-minute to determine exactly when you should be getting in the trade. So here we're looking at a 3-candle breakout on the 15-minute time frame for a new low of day on EuroCAD. You see the EMAs could have been better, but the TDI was in the sell zone all day. You're breaking for a new low on the RSI. You're breaking for a new low on price action. So when that candle closed at 9 o'clock, you had a lot of probability in your favor that it was going to move lower. And it does. It falls 22, 23 pips, only risking about 11 or 12. That entry on the close of that candle at 9 a.m. is confirmed because on the 5-minute, you can see you also get this same RSI cross in position with the trend line that you're looking for on the 15-minute or the 1-hour. Like I said, way back when we started this chapter, it's the same signal on all the time frames. But when you can find a 5-minute cross, as we see here, and a 5-minute shift candle inside a 15-minute formation, that's more indication to you that it is going to be a breakout that goes into your direction, goes in your favor. And this goes 15 pips, it goes 20 pips, it actually goes almost a full 2R. You're risking about 11, you get 22. Depending on your spread, you're getting 2-1 on this trade. And the 5-minute cross really helps that. You don't need it though, and I want you to understand that. Here, we have a 15-minute shift candle on Euro AUD at about 23, so right before midnight. It's about 11 p.m. The shift candle down comes as we have a perfect TDI in the sell zone. RSI is under the trend line, so everything looks good on the 15-minute. And if you were just using the 15-minute, this could be a breakout. But if you check the shorter time frames, for example, look at the 1-minute, you'll see here that you do have a 1-minute cross in the candle before that confirms to you that you're good to go to trade this to the short side. That RSI crossing underneath the trend line, crossing underneath the liquid 50 is exactly what we look for on the higher time frames, but because we can find it here on the shorter time frames within that entry candle, it's making it even more of a probable trade for us. Notice the liquid 50 here on the 1 minute just continues to move lower and lower and lower. Even after it hits oversold, price continues to go lower. So with that liquid 50 in the sell zone dropping, that's going to help you feel confident to stay in the trade. Once you enter a trade, you can use the 1 minute or 5 minute liquid 50 to say, yes, we're going to keep moving in that direction. The reason I rely on the shorter time frames for that purpose, for that liquid 50 changing, is because they are shorter, so they're going to react a little bit quicker and potentially get me out of the trade with more profit or with a smaller loss than if I was using a higher time frame. Here, you have a 15-minute shift candle off the 50, perfect TDI in the sell zone, breaking structure, breaking the ascending trend line. So you're going to be looking for shorts. You're going to be looking to short it at 2:45 in the morning on the candle close. But if you look here within that candle, again, on the 1 minute, you find the RSI crossing under the liquid 50 in the sell zone under the trend line, which would be that same confirmation cross we're looking for. So you see the 1 minute cross within your candle. You see it's a nice strong bar there on the 1 minute when you get that cross. You wait for the 15-minute candle to close, and then you take your entry. Having the 1 minute or 5 minute cross confirms the 15-minute formation. Here, another example, a 3-candle formation off the 21 EMA. RSI coming down through the liquid 50, down through the trend line. EMA says sell, TDI says sell. You know that by now. This is clearly short biased. And as you can see, it falls 16 pips, only risking 6. If we take a look, there's actually no 1 minute cross inside that 3-candle formation. But what happens? The liquid 50 drops into the sell zone, holds into the sell zone even when it retests here, doesn't break above the 200 EMA on the 1 minute, and then ends up coming lower. That 200 EMA on the 1 minute is the same thing as the 21 EMA on the 15 minute. Just keep that in mind. It's very, very similar. So that's your red 21 EMA when you're looking at a 15-minute chart. And we know that if it breaks that, it's probably dead and we wouldn't want it anyway. So seeing it hold the 20 or the 200 EMA here, seeing it hold the liquid 50 into the sell zone here and pull that liquid 50 to the downside helps keep you in the trade. So understand you don't need the cross, but it helps. If you can find the 5 minute or 1 minute cross, it really helps. Here, liquid 50 is in the buy zone, pops down into the sell zone there, but we'll say it's in the buy zone majority of the day. EMA is coming into an uptrend here on the short term, but the 800 EMA was way above us. So overall, still in the downtrend. So a counter trend shift candle here, stop is 10 pips, and this goes 22 very quickly. But watch, if you give this trade time, because you find a powerful 1 minute cross here, you give this trade time, it ends up running way higher all the way to the 800 EMA as it would when we are trading counter trend. We know if the liquid 50 says buy it and the 800 EMA is on top with the shorter term EMA saying to go long as well, that 800 EMA is your ceiling. So here, if you just read this trade candle by candle on the 15 minute, using this 1 minute cross here that happens in that formation, in that shift candle formation, you're then able to read it candle by candle, take it all the way up to the 800 EMA. You're talking 70, 80 pips, only risking 10. So again, it starts with the 15-minute shift candle inside that 6 a.m. candle. So from 5:45 to 6 a.m., you see there's a 1 minute cross there in the buy zone. And that confirms that if this closes bullish, that 1 minute cross is going to be the confirmation that this is the best shift candle it could be. And look at the liquid 50, rising, rising, rising. Where does it end up? All the way to the 800 EMA, 80 pips higher. Here, you're only looking at about 20 pips. Here's where it goes to its full extent on the 80. So again, use the 15 minute to find the window. Use the 1 minute and the 5 minute to find an even more precise entry, even more confirmation that you're going in the right direction, and then go back to the 15 minute and read it for your exit. Use the 1 minute and the 5 minute liquid 50 to tell you if trend is changing. For example, on this trade, if the 1 minute liquid 50 had started to come down into the sell zone, that's where I would look to get out of the trade. If the 5 minute liquid 50, if I find a confirmation on the 5 minute and the 5 minute liquid 50 starts to come against me, coming into the sell zone, if we're long, then I'm going to say trend might be changing. I should be getting out of the trade potentially. And I'm going to rely on the 15-minute exits more than anything. We're going to look at the 8 EMA. I'm going to look at the 21 EMA. I'm going to see, am I close to take profit yet? And that's how I'm going to be able to judge the best probable exit. So let's review the checklist one more time. The first thing we're looking for every day, what is the direction of the liquid 50? Are we in the buy zone? Are we in the sell zone? Where are we going? Is it in one zone all day or is it swapping? Is it sitting at the stationary 50? Understanding where that liquid 50 is the first thing you should be doing every day. The next thing, confirm or deny that direction with the EMAs. After you confirm or deny that direction, if you can start to say, okay, liquid 50 is in the sell zone, EMA say sell, we're trying to sell it, you want to then make sure, are we outside the Asian range? And Asian range valid? If so, you want to keep moving down the checklist. Ask yourself, is enough space on ADR? And is this entry candle off a solid EMA, not the 8? It's got to come off the 21, the 50, or the 200. So if you've got space on ADR, it's coming off a solid candle. If you're using a solid candle formation for the breakout, if it's breaking for a new high of day, low of day, those are even more confirmations that the trade is going to work out in your favor. And then you're going to work your way down all the way through to see the steps within the system. You're going to make sure that you start, like I said, with the liquid 50. From there, you're going to confirm the direction with the EMAs and then work through that entire checklist. When you enter the trade, the RSI must be in the proper position. The candle formation must be a proper breakout formation. And you always want to ask yourself, what could be better about this setup? If anything could be better, you want to weigh that piece of the trade, weigh that parameter of the trade properly, and potentially size down or avoid the trade entirely. Keep in mind, as we summarize this approach, guys, you want to use only the 1 hour or 15 minute to identify the trend, depending on your approach. If you're looking to swing trade and you're only looking to trade on the hour, at the hour, every hour, then you want to focus on just the 1 hour chart. If you don't want to be glued to the charts all day, the 1 hour chart using these RSI confirmation and candle confirmation crosses are going to give you the best probable setups. If you're looking to day trade, you want to focus on the 15 minute, and either way, whether you're using the 15 or the 1 hour, you're going to use the TDI to confirm the trend with the EMAs and make sure that you work through the checklist. Check ADR, check the Asian range, check if it's overbought or oversold, check if it's breaking for a new high of day or low of day. All of these things, if you start to say, look, it's busted ADR, it's already gone like 90% of what it does on an average. If it's not breaking for a new high of day, if it's already overbought, why would I buy it? There's too many parameters that just don't fit. So make sure you're confirming the trend with the TDI, confirming the trend with the EMAs, making sure it's got space on ADR, and then using the shorter term time frames to confirm your entry. Go down to the 5 minute, go down to the 1 minute, and see where's the liquid 50, where's the RSI. Are we finding a proper cross in this entry candle? And if it's not there, wait. You will find a better entry. Trust that 15-minute TDI with your life. That is the best thing you can do after watching this course, is trust the 15-minute or the 1 hour TDI with your life. That is going to tell you the direction you need to be trading. If the EMAs don't line up, move on. Find a better setup, because you've seen now hundreds of examples through this course of trades that are in perfect trend that break out and run for multiple days or multiple hours for you in that direction. That's where you want the money. You don't need to scalp around. You don't need to trade in ranges. You need to find trending pairs and trade them on their breakouts. Remember, entries are on strong candle formations with TDI confirmation. And if you want to be safe, you wait until that candle closes. You enter at 8:15, you enter at 8:30, you enter at 8:45 on the 15-minute chart. If you're using the hour chart, you're entering your trades on the close. 8 a.m., 9 a.m., 10 a.m., 11 a.m. That's when you're looking to take those trades. So again, last point, trust the TDI over everything. That's the foundation for this system. That's where you're going to find the most consistency. It's TDI, EMAs, and ADR. If anything is not clear, guys, please drop a comment below. Send me an email with your markups if you'd like me to go over anything with you. Check the course over and over again. Repeat this chapter over and over again until you really feel like you understand what a great long trade looks like and what a great short trade looks like. Like I said, if you have any questions, hit the comments below, and I'll see you in the final chapter.